January 2nd, 2026. Silver closes at $81.27 per ounce, the highest price in human history, higher than when the Hunt brothers tried to corner the market in 1980, higher than the precious metals mania of 2011. A 45-year record shattered. And if you blinked, you missed what happened next. Because 72 hours later, silver's at $74, a 9% nosedive in 3 days. And if you're watching CNBC, they're calling it profit taking, market correction, normal volatility. The talking heads are smiling, saying we expected some pullback after such a strong run. They're lying to you. Starting tomorrow morning, January 9th, $6.8 billion in silver futures gets dumped on the market. Not panic selling, not investors changing their minds, forced liquidation, algorithmic, mechanical, unavoidable. Passive index funds that track the Bloomberg Commodities Index, they're being required, not asked, required, to sell 12% of total COMEX open interest. 7 days, regardless of price, regardless of fundamentals, regardless of anything. And here's the kicker. Kenny Hu, a strategist at Citigroup who's been analyzing commodity index flows for over a decade, just went on record. Quote, "I've been running this process for many years, and we haven't seen any outsized flow like this one." Let that sink in. A decade of watching these markets, he's never seen forced selling this large. So here's what you need to decide in the next 12 minutes. Is this the correction that kills the silver rally? Or is this the buying opportunity you'll be kicking yourself for missing 2 months from now when silver's back at $90? Because there's a pattern here. I'm going to show it to you. 3 times in the last 25 years, this exact sequence has played out. Same stages, same forced selling, same violent recovery on the other side, and we're watching it unfold right now, in real time. While most people have no idea what's actually happening, the only question is whether you position before January 15th, or whether you're still trying to figure out what happened when silver's 30-50% higher and the window's already closed. Stay with me, because what I'm about to show you, Wall Street doesn't want you connecting these dots. Let me ask you something. Do you know how commodity indices actually work? Most people don't, and that's by design. There's a cycle. Repeats every single year, 4 stages, same order every time. And if you know the pattern, if you can see what's coming in stage 4, you position in stage 3 while everyone else is confused. Here's how it works. Stage 1 is what they call normal weighting and equilibrium. Boring name for a simple concept. Silver sits at its target allocation in the major commodity indices, Bloomberg Commodities Index, S&P Goldman Sachs Commodity Index. These things track $109 billion in assets. That's billion with a B. Silver's normal target, about 4%. So roughly $4.4 billion in silver futures sitting in passive funds. Everything's balanced. The system hums along, no drama. Stage 2 is where it gets interesting. One commodity massively outperforms everything else. 2025, that was silver's year, up 142%. Best performance since 1980, while oil stayed flat. While copper did nothing, silver exploded. And when one commodity goes parabolic, its weighting in these indices grows automatically. It's just math. By December 2025, silver's weighting had ballooned to 9% of the Bloomberg index, more than double the target. That's $9.8 billion in silver futures. The imbalance is growing every day the rally continues. The index is getting more and more lopsided. And that brings us to stage 3, right now, this week. Index administrators hit the reset button. They have to. It's in the rules. Silver drops from 9% back to 4%, no exceptions. The math is brutal and simple. $9.8 billion down to $4.4 billion equals $5.4 billion that must be sold. But wait, it gets worse. Because it's not just Bloomberg rebalancing. S&P Goldman Sachs is doing the same thing. Simultaneously, Citigroup's estimate, $6.8 billion in total forced selling. That's equivalent to 89 million ounces of silver being dumped on the market over 7 days. And here's what nobody tells you. It's not discretionary. Fund managers can't look at the fundamentals and say, you know what? Silver's in a structural supply deficit. Let's hold. The algorithms don't care about fundamentals. The index rules say sell. The computers execute. The contracts get liquidated. Period. Stage 4 is what happens after. January 16th. The forced selling stops. The mechanical pressure disappears. And we find out if fundamentals are strong enough to drive the next leg up. Spoiler alert, they always are. But don't take my word for it. Let me prove it to you with 3 historical examples. Same pattern, different years, identical outcome every single time. Silver surges 47.9% coming off COVID lows. Gold gains 25%, which is great. But silver doubles gold's performance. By December 2020, silver's index weighting is way above target. You see where this is going. January 2021 rolls around, the rebalancing starts, passive funds begin their algorithmic selling, billions in outflows hitting the market, and then something wild happens. Reddit discovers silver, Wall Street silver is born, Retail investors see institutional money selling and they think it's manipulation. They think JP Morgan's pushing the price down. So what do? They buy aggressively. The result? Silver absorbs billions in forced index selling and keeps rallying anyway. The mechanical selling that was supposed to create a 7-10% correction instead becomes a launch pad. Silver hits $28.50 by the end of the rebalancing period. That's 18% higher than where it started when the selling began. The forced sellers got run over. The people who understood what was happening, they made a fortune. Fast forward to 2023, silver gains modest returns compared to gold. Nothing crazy, but enough to push weightings slightly above target. January 2024. Here comes the rebalancing again. Silver dips from $24.50 to $20.80. A 7% correction over the 7-day window. And the financial media? Silver rally losing steam. Precious metals correction underway. All the headlines you'd expect. 3 weeks later, silver's back at $24.50. The dip got bought. But here's where it gets good. By April, silver blows through $28. By May, it's touching $30. That 7% January dip, that was the entry point. Anyone who panicked during the rebalancing, anyone who believed the correction narrative, they missed the 40% rally that followed over the next 5 months. The pattern held. Mechanical selling, temporary dip, fundamental-driven recovery, new highs. Now this one's important because it's the most recent data we have. 2024 sees silver rally steadily through the year. By December, index weightings are elevated. $20.26. The numbers are public. You can verify every single thing I'm about to tell you. The scale. Citigroup estimates $6.8 billion in silver futures must be sold between January 9th and 15th. That represents about 12% of total open interest on COMEX. Kenny Hu at Citi, the guy who's been tracking these flows for over a decade, he's never seen selling this large relative to market size. Think about that. This isn't routine. This is structural deleveraging compressed into 7 trading days. The mechanics. Bloomberg Commodities Index current silver weighting, 9%. Target weighting for 2026, 3.98%. That's a 5.02 percentage point drop. With $109 billion tracking the index, that's $5.47 billion from Bloomberg alone. Add S&P, Goldman Sachs, and the other trackers, you get Citigroup's $6.8 billion total. And here's the thing, it's evenly distributed, roughly $970 million per day, every single day, regardless of what the price does. The algorithm, these aren't human traders making market calls. This is passive index rebalancing. The funds don't get to decide if silver fundamentals look strong. They don't get to evaluate whether the supply deficit matters. They don't get to consider exploding industrial demand. The index rules require rebalancing. The algorithms execute. The contracts are sold. It's mechanical. It's mandatory. It's unstoppable. The evidence. So far, January 2nd, silver hits $81.27, all-time high. January 8th, silver's at $74. That's a 7.27 drop, 9% in 6 days. And the official rebalancing window hasn't even started yet. That's just positioning. Fund managers selling early to avoid the rush. The actual algorithmic liquidation begins tomorrow. Deutsche Bank just published analysis calling this a period of vulnerability for silver through mid-January. Goldman Sachs estimated the silver selling equals about 10% of average daily trading volume based on recent elevated activity. That's massive relative to normal market flows. It creates what traders call mechanical pressure. Price declines that have nothing to do with fundamentals, just supply-demand imbalance in paper futures. The margin trap. And oh, by the way, CME Group raised margin requirements in late December specifically because of silver's volatility. So traders need more capital to hold the same positions. When mechanical selling hits and margins are higher, it amplifies the pressure. Some leveraged traders get forced out not because they want to sell, but because they literally can't meet the increased capital requirements. The timeline, January 9th through 15th, 7 trading days. By January 16th, it's over. The rebalancing is complete. The forced selling stops. The algorithmic pressure disappears. And then we find out if fundamentals matter. So let's talk fundamentals, because they haven't changed. Not even a little. Supply deficit. Silver is in its 5th consecutive year of structural deficit. 5th year. Global demand exceeds supply by about 200 million ounces annually. That deficit has to come from somewhere. It comes from above-ground stockpiles, exchange inventories, vaults, which is exactly what we're seeing. COMEX inventory. Registered silver, that's metal available for delivery against futures contracts, has dropped 73% since 2020, from 346 million ounces to about 127 million today. Decade low levels. In December 2025, over 47 million ounces got claimed in just the first 4 trading days of the month. Unprecedented delivery requests. The physical market is tight, extremely tight. Industrial demand. Solar panel production consumed 232 million ounces in 2024. That's 19% of total global silver supply. And solar installations are growing 64% year over year, not slowing down. Accelerating. Electric vehicles use 25 to 50 grams of silver per vehicle. With 20 million EVs projected for 2025-2026, that's another 1632 million ounces of demand. Electronics, medical applications, 5G infrastructure, all growing simultaneously. The mathematics. By 2030, peer-reviewed research, published in Science Direct, not some guy's blog, peer-reviewed scientific research, projects that supply will only meet 62 to 70% of total silver demand. That's not a prediction, that's mathematics. You can't mine silver that doesn't exist. And here's the problem. 72% of silver comes as a byproduct of copper, zinc, and lead mining. It doesn't respond to price signals the way primary silver mines do. Even if silver hits $200 per ounce, you're not getting more byproduct silver unless copper economics justify opening more copper mines. Supply is structurally inelastic. The gold-silver ratio, currently sitting around 80.1. 80 ounces of silver to buy 1 ounce of gold. Historical average over the past century, 60.1. Historical norm over 5 millennia of human civilization, 15.1. Mining ratio, the actual amount that comes out of the ground, 8:1. 8 ounces of silver mined for every ounce of gold, but the price ratio is 80.1. Something is mathematically broken. And when ratios get this extended, they compress violently. Bank of America's targets. They just published their 2026 silver forecasts. Conservative case, $135 per ounce. Bull case, $309 per ounce. That's not some fringe analyst on YouTube. That's Bank of America, one of the largest financial institutions on earth, putting their name on a 305% upside target from current levels. So let me connect the dots for you. Fundamentals, screaming bullish. Supply deficit, inventory depletion, industrial demand explosion, ratio compression setup, major bank targets at $100, $300. And right now, this week, we're getting $6.8 billion in mechanical selling that has nothing to do with any of those fundamentals. That's not a crisis, that's an opportunity. So what do you actually do with this information? First, understand the timeline, January 9th through 15th, 7 days. The forced selling is concentrated in this window. By January 16th, it's over. The mechanical pressure disappears. If you're positioning, you're doing it before January 15th, not after. After is too late. Second, watch the price. Silver already dropped from $81 to $74. If it keeps falling towards 70, 72 during the rebalancing, that's algorithmic selling, creating a temporary discount on an asset with bullish fundamentals. That's not catching a falling knife. That's understanding the knife is being pushed down mechanically and will stop falling on a specific date. Third, distinguish between paper and physical. Index funds are selling futures contracts, paper silver, but physical demand? Still strong. Premiums on silver eagles and bars haven't collapsed. Dealers are reporting strong retail buying. The futures market is being mechanically rebalanced while the physical market is being accumulated. Pay attention to that divergence. Fourth, don't try to time the exact bottom. The selling happens over 7 days. You don't know which day creates the low. Dollar cost average through the window. Scale in. Let the forced selling create multiple opportunities instead of trying to nail one perfect entry. Fifth, and this is critical, you need conviction in the fundamentals. The rebalancing is temporary noise. 7 days, then it's over. The supply deficit, still there on January 16th. COMEX inventory drain, still accelerating. Solar demand, still growing. None of that changes because passive index funds adjusted their weightings. If you believe in the long-term bull case for silver, temporary mechanical selling is a gift, not a threat. And finally, remember the pattern. 2021, 2024, 2025, Forced selling, temporary dip, fundamental-driven recovery, every single time. The pattern doesn't care about your emotions. It doesn't care what CNBC says. It just repeats, like clockwork, like mathematics, like gravity. Let me bring this home. Silver hit $81 last week. All-time record. $6.8 billion in forced selling started this week. It drops to 74, maybe lower in the next few days. And then January 15th arrives. The rebalancing completes. The mechanical pressure stops. And we find out if silver fundamentals are strong enough to drive the next leg higher. Based on the pattern, based on history, based on supply-demand mathematics, the answer is yes, not maybe, not hopefully. Yes, because nothing about the supply deficit changed, nothing about industrial demand changed, nothing about COMEX inventory depletion changed. The only thing that changed is 7 days of algorithmic selling that has to happen because index rules require it. That's not bearish, that's mechanical. And when mechanical selling creates a temporary dip in an asset with structural bull market fundamentals, that's called an opportunity. January 9th through 15th, 7 days. The setup is complete, the timeline is set, the forced selling is in motion. What you do in the next week determines whether you capitalize on this pattern or watch it happen from the sidelines. I want to know what you think. Drop a comment. Are you positioning during the rebalancing or waiting for confirmation after? Tell me what you're seeing in the silver market. I read every single comment. And subscribe right now because the next video breaks down exactly what happens if silver hits Bank of America's $135, $309 targets in 2026. I'll show you which mining stocks have the most leverage, which physical allocation makes sense, and why the gold-silver ratio compression trade might be the single best risk-reward setup in precious metals right now. The rebalancing is temporary, the fundamentals are permanent, the pattern is absolute. Your decision is yours. Thanks for watching. And remember, the people who profit from these transitions aren't the ones with the most money. They're the ones with the best information and the courage to act when everyone else is confused.